What is the four-letter word in investing that is the most risky? And can this straightforward phrase, which is so full with context and meaning, truly hold you back from mastering the art and science of stock trading? Yes. So is that it? Of course not. But every participant on Wall Street has to understand and maintain awareness of this four-letter term. It can be detrimental to own too many stocks or to build up an excessive amount of one stock at the incorrect point in the circle. Fear, according to some, is the most hazardous word. That is a wise decision. After a protracted dry period, the market will undoubtedly indicate that it's time to muster up the guts to purchase equities following a successful day. However, fear might unnecessarily halt you in your tracks. For example, worry sparked by a typical slump following a company's initial breakout can prompt an investor to sell their shares too soon. Good day. Hello and welcome to Stealth Wealth. For today's video, I'll be talking about the four most dangerous words in investing. Investing is the best way to put your money on the fast track and watch it grow exponentially. But there are things in investing that you need to be aware of and stay away from. Later in this video, we will uncover words you will need to run from when it comes to investing. Make sure to like and subscribe to this channel, and don't forget to click the notification bell for more financial advice. All of these situations are cause for concern, but the yield curve is the one that has drawn investors' attention the most. The yield curve is a market-based indicator that displays the opinions of investors, portfolio managers, and bond traders from across the world in real time. According to one view, inversion represents expectations for interest rates in the future. An inversion shows that the markets anticipate a decrease in yields and a cut in short-term interest rates from the Fed. A recession frequently precedes an inversion, but not always. This has made equities investors more worried. The four riskiest words in investing, according to John Templeton, are, "This time it's different." While we firmly believe this to be true, it would be naive to assume that the extraordinary global monetary policy implemented over the past 10 years, including asset purchases and a 0% interest rate policy, will not have unintended consequences, with an inverted yield curve potentially being one of them. What happens if the yield curve is accurate and a recession is imminent? According to research, it is not imminent and there is still opportunity for the equity markets to rise. A recession has often occurred 22 months following an inversion of the rates on the 2-year and the 10-year Treasury bills, per a research by Credit Suisse. Furthermore, after a yield curve inversion, markets can still give investors favorable returns. According to Dow Jones market data, between the inversion and the beginning of the recession, the S&P 500 has increased by an average of 13% since 1978. According to LPL Financial's analysis, the S&P 500 index did not reach its top in the previous 5 recessions until over a year after the yield curve inverted, with a median gain of approximately 22%. Just a few of the many causes for concern include those stated above. The historically low unemployment and interest rates, the fact that equities frequently do well in election years, the astonishingly healthy profitability for tech companies, the solid consumer spending, and other factors are all positives to take into account. The next market drop and economic recession will occur not if, but when. Numerous studies indicate that trying to time the market, including trying to sell at the peak and buy again after a fall, is a losing strategy. Question: is there ever a period when it was more crucial to define your risk and return goals? Can you remember a period when intelligent, wide diversification was more crucial than it is right now? Let me know in the comment section below. Investors may be feeling happy given the length of this economic growth and the high returns on equities. But the majority of them are feeling a little anxious. No one of us will accurately forecast the upcoming slump. Stocks may continue to rise for a while. The wise course of action would be to carefully consider your investing plan and make sure that it's in line with your unique aims and aspirations. The four words, this time is different, are regarded as the riskiest in the investment world. They are risky since it frequently doesn't change. What seems to be a novel has already occurred and things will return to normal. I've definitely given the term some second thought. Dennis Lynch just discussed it at a Morningstar conference. He runs Morgan Stanley's Counterpoint Global Division and is a successful investor in emerging technology. It's always different this time. It's only a matter of degree, he prefers to say. The general rule of thumb still holds true in some circumstances, such as cyclical industries. Analysts and commentators continue to make sweeping predictions about how the future will enable a new route, generally around the peak or bottom of the roller coaster cycles, which are as predictable as rain in Vancouver. There are other instances, but investor behaviors where my thoughts keep returning to in terms of an aspect of investment that is never different this time. Another thing, typically, while investing, ordinary investors are enabled to overcome their greed and anxiety. Anywhere in the world, this is the same. They attempt to invest all of their capital in one successful asset. In a bullish market, they fail to rebalance from the asset at the proper moment, expecting profits to keep increasing, and they wind up losing money. Others stay away from the market entirely out of fear of losing money until a buddy buys a vehicle after selling a scooter. Because they are afraid of losing money, some people hang on to disastrous investments. Being cautious in the market and waiting to maximize your returns are both positive traits. However, different factors will contribute to market volatility at various times. That must be understood, and valuation must be given the proper weight. According to Morgan Housel, a partner at Collaborative Fund Management, the technologies, trends, tragedies, and winners, the events that take place, are always in flux and may be almost hard to forecast. However, the actions, attitudes, and beliefs that motivate people tend to remain constant. They will still be the same in 100 years from now as they are now. Behaviors are trustworthy and significant. Good returns will come from a strong and consistent routine, while poor and erratic behavior can overpower other favorable factors like strong fund performance and low fees. It may sound odd, but consistent errors or misconceptions may more than cancel out all the excellent work you put in. In order to enhance my explanation, I'll focus on 3 specific behaviors, bearing in mind that I'm speaking generally about investors. The first is performance chasing, in which investors place undue stock in recent success. They are predisposed to choose managers and funds who have had recent success, rather than elements that have far longer lifespan, like an investing strategy or a person's character. Purchases are motivated by 1 to 3 year returns. The truth is that fund rankings can alter abruptly. A manager's winning plan from this year could not be the best one from the following one. There must be further justifications for your choice. I advise you to concentrate on 10-year returns if you feel forced to buy a fund only based on historical performance. Second, acting out of fear and greed. Investors frequently go against what Warren Buffett advises. When people are scared or greedy, they will sell, and when, they will purchase. Buffett acts in the opposite way for 2 reasons. In scary times, the terrible news is known and future expectations, as shown by values, are at an all-time low. It makes a lovely combo. On the other hand, when markets are soaring, prices already presuming positive outcomes, the attention is on the excellent things that could happen. If you plan to invest in stocks, you must have the ability to withstand the expected turbulence. If you sell at a loss, the advantage of taking the risk is lost. Lastly, moving the goalpost. When markets experience extremes, investors frequently alter their goals. The capital preservation component of an investment strategy is often neglected in prosperous times in favor of better returns. When prices are low, everything revolves on limiting future losses. Investors gain more self-assurance in their opinions and short-term tactics during highs and lows. Your goals shouldn't fluctuate with the ups and downs of the market. Instead, your plan should account for them. If you have a longer time horizon, for instance, create plans to contribute in both good and poor markets. It is best to invest more and early, even if it hurts while markets are rising. Saving aside a source of cash is vital for shorter-term demands. Supply and demand dynamics in the resource sectors are difficult to predict. But if you can alter your investing strategy, it's time to try something new this time if you keep doing the same things wrong. You may protect yourself from this extremely damaging feeling by using prudent market timing, discipline, and sell rules, especially when a stock is no longer functioning appropriately. IBD's, or Investors Business Daily approach, is purchasing equities at or just below their 52-week highs. Breakouts, however, are not foolproof. When anything goes wrong after you make a purchase, you need insurance, not hope. The insurance premium you must pay in order to continue to compete in the investment world is to limit your losses. The majority of mutual funds and investing firms state that past performance does not guarantee future results, but prior performance, I'm not talking about recent performance, but rather historical data, is a crucial factor to take into account when making an investment. You cannot ignore past performance by claiming that this time is different. It provides some insight into the investment and the trajectory of returns. Different bubbles and market circumstances will emerge and go. Investment valuation, however, will not change. The market will be affected by various factors at various periods. However, if your assets were picked after careful consideration, sound foundations, and competent management, they will continue to perform well over time. However, let's be honest, retail investors lack these abilities. If they establish an investment policy statement and adhere to it throughout the season, it will be better. P/E ratio is one of the several valuation techniques, and there are others as well. It's critical to recognize when differences only seem and when they actually exist. Is there actually a factor that determines whether the markets are growing or dropping? Or is it a merely herd behavior that causes the markets to go through a transitory period of acting a specific way? Thanks for watching, and invest in yourself by tapping the like, subscribe, and notification bell so you don't miss any of my financial tips. Till next time.